From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Farrell. Lift the markets after data came out that was the last most important data point. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrell.
Coming up, disinflation dreams kept afloat as PCE cools. Nike sinks on a weak revenue outlook, and oil set for a weekly gain as Red Sea attacks disrupt trade. We begin with the big issue. Growth worries start to slip in.
There is likely going to be a growth scare time.
We do see the economy slowing.
Growth slowdown, slow growth in 2024.
24 growth is going to be less than 23.
Just because there's so much optimism in the markets right now.
An uber amount of optimism coming out.
Even if you get a soft landing, you're going to have slower growth.
The soft landing opportunity has increased.
When you think about the Fed's pivot or change in language and direction, it really does take out one risk.
The Fed now has the latitude to start adjusting policy rates lower because inflation's come down enough.
In the second half of next year, there's a very meaningful risk that you see a rebound in inflation.
I wouldn't think that would be a huge risk into next year, growth being a much bigger one.
Can we get the best of both worlds? Can we get lower inflation and strong growth?
I don't really see any meaningful catalysts to sort of break us out of what could be a really sluggish growth backdrop.
This is going to be the main driver of market.
Joining us now to discuss is Morgan Stanley's Michael Kushba and Mary Ann Bartels of Sanctuary Wealth. I just want to start with you, Mary Ann, about whether you're more worried about just a reignition of inflation or some sort of more material slowdown that looks weaker than people are expecting.
So going into 2024, we think inflation continues to go down. And in fact, I would not be surprised either in 2024 or in 2025, we actually go to a negative CPI. And I don't think that's being factored in. In terms of growth, when I'm analyzing the year-to-year change in real growth, it's actually improving. So I think it's actually possible you have inflation come down lower than people expect in 24 and have better growth. That's positive for earnings. That's positive for the equity market. Now, for the income market, in terms of fixed income, I think short term we can get a backup in rates because rates have moved. But I think if inflation continues to drop and the Fed begins cutting rates, rates are going to fall a lot lower than people expect. So we're calling the year of 2024 the bucking bull. I think people are going to be bucking the bull market in both bonds and stocks for 2024.
Yeah, that seems like a good guess, given the fact that that's what we've been looking at right now in terms of PCA data that came in lower than expected. Michael Kushma, do you agree with that, this idea of immaculate disinflation on steroids with better growth and weaker inflation?
It does look pretty good at the moment. Inflation is coming down faster than expected, faster than the Fed expected, faster than I expected, faster than the market expected. And this sort of immaculate disinflation with growth stronger this year than it was in previous years and inflation coming down sets the markets up for a very good 2024. The big question is, will inflation continue to fall as expected? If financial conditions ease too much, maybe inflation doesn't fall. The economy does better than expected. People had forecasted a pretty weak 2024. This easing of financial conditions, which is taking us back to the levels of early this year, if not previous in 2020 and 2022, will be supportive of the economy next year when there's no real evidence of a significant slowdown. But most importantly, it's truncating the downside risk. It's truncating that significant hard landing, which people have been worried about for a year until the past couple of months. And that really bolsters the longer term. Whatever happens in 24 bolsters the longer term outlook for the economy and for inflation.
So how low can bond yields go in this sort of immaculate disinflation, even with the potential risk of the reignition of inflation, or at least that it remains stickier just because financial conditions are easier? Michael, do you see yields getting below 3.5% on a 10-year?
3.5% will be a difficult level to get through unless unless you believe that the Fed's terminal forecast about 2.5% is the long-term fair value for the Fed funds rate, if that is achieved, if that is correct, and we're on the path to get back to that 2.5%, then 3.5% is easily doable. If, however, the economy rebounds in 2024, inflation plateaus above 2%, then 3.5% will be very, very difficult and more likely to be 4%. Going forward. So I think now we're getting to the critical juncture is how are things going to perform in the out years? We know interest rates are coming down in 2024. We don't know how much, but it'll be meaningful. 100, 150 basis points is easily doable, but farther out, are we going to get much below 4? That depends how the economy is perceived to perform in 25, 26.
Well, and then raises a question, Mary Ann, of whether you're going into some of these cyclicals, et cetera, and not necessarily betting as much on the bond space simply because it seems like the bucking bull theory of, yes, inflation coming in below expectations and growth remaining strong will keep alive some of those longer term inflation goals.
So when I look at the 10-year Treasury yield, I just want to add, I think what people are not pricing in is that at some point, whether it's 24 or 25, the 10-year can go to 2.5. And I'm always looking for what is possible that the market is not expecting. And from technical analysis, 2.5% is actually doable. So if you actually do get in those inflation numbers down, I think that's going to be a huge surprise. And if rates continue to fall the way we think they can, that's really going to continue to ignite the equity market. Now, we're starting to see a broadening. You're starting to see what didn't work this year, like small caps, banks, and financials rally. But the question is, are those the new leadership? And we don't think that's where the new leadership is. We do think the market stays cyclical. We think the new emerging leadership is in the industrial space, leveraged into Biden's legislations that he's passed, which everybody's talked about, the CHIPS Act, the Infrastructure Act, and the Inflation Protection Act. But I think the true leadership in the market remains technology. And the pocket that we think sustains that leadership are semiconductors. I know they're up a lot this year. They certainly can consolidate going into 2024, but I still see significant upside. In fact, they're just starting a new cycle. And when they start a new upcycle, it generally lasts for a couple of years. And in terms of the Magnificent Seven, they were actually supported by earnings. It wasn't air pudding and wind sauce for these stocks. They actually produced the earnings this year when the other stocks did not produce the earnings. So I do think that they can continue to participate, but you'll see that tech space actually broaden out.
All right. The Fed's preferred inflation gauge is cooling in November, just basically in tandem with what you both are talking about. Even as growth worries start to pick up, Bloomberg's Katie Greifeld joining us now for more. Katie, it's been a while. What are you seeing out there?
Well, you take a look at some of the numbers that we got this morning at 8:30 a.m. We do have some superlatives here. You take a look at a monthly basis, the overall PCE price index actually fell 0.1% from October. That is the first monthly decline since April 2020. Meanwhile, you take a look at the annualized rate, that measure advancing 2.6% from a year earlier. That is the smallest gain since February 2021. Meanwhile, you take a look at personal spending, rising 0.2% on a monthly basis, just below forecast, while personal income rose by an as expected 0.4%. You add that together, you have that sustained easing in inflation, you have still resilient household demand. It's giving a lot of juice to those who've been saying that there's a soft landing coming for this economy. Meanwhile, though, you take a look at the reaction in markets right now. It's not huge. You take a look at S&P 500 futures up by about 0.2%, as you can see on your screen right now. Then you take a look at bond yields, and they're pretty much unchanged, maybe down 2 basis points or so across the curve. But relative to what we have seen, not a huge reaction. And the reason why, we just had this conversation with Bank of America's Michael Gapin. This was pretty much a status quo number. Pretty much priced in because a lot has been priced in over the last 2 months. The S&P 500, of course, rocketing higher. It's now 24% higher on the year, and a round trip in bond yields with a mile-high range. Currently, right now, the 10-year yield trading at about 3.85%. this morning. That is just about where it entered 2023. So a lot of muscle has been put behind this immaculate disinflation narrative. But of course, we'll see if that continues to be the case in 2024. Maybe some of those growth fears start to overwhelm what right now is a very, very broad-based rally, Lisa.
I love how we're trying to come up with the potential downside risk, Katie. It feels almost like a futile point when every data point is better than the next. Katie, thank you so much. Still with us, Michael Kushma and Marianne Bartels. I am curious, Michael, we're looking at the rally in risk assets and fixed income that has been quite significant as well. High yield bond spreads, the extra yield over benchmark rates, have contracted to the lowest going back to April 2022, not April 2023, at a time where people are still talking about default risk when people have to refinance. Do you think that this is adequately already priced in some of the strength in this immaculate disinflation kind of growth that we're talking about next year?
It has, but it's more than that. It's the fact that the Fed has pivoted in a relatively hard way. My original view was that the Fed would pivot to high for long, but no more rate hikes, and slowly in Q1 next year, they'll talk about rate cuts. Clearly, they've brought forward their worries about the economy and not so much worried about inflation anymore. But that truncating of recession risk, that reducing the probability of a hard landing by a meaningful amount by their pivot, that's the number one problem for a risk for high yield is a recession. If there is no recession, their defaults will rise to a more normal level. There would clearly be pockets of companies that profited and did very well in a zero yield or a very low yield environment and will struggle in a higher interest rate environment. That doesn't mean the market as a whole won't continue to do well. My analogy, the best analogy I can come up with is the mid-1990s, where the Fed pivoted hard in 1995, cut rates after raising them dramatically in 94, and off we went for 2 to 3 years of exceptionally strong credit performance, because the probabilities of recession had dropped to not to zero, but to much lower levels, which allowed high yield to continue to do well. In particular, real interest rates for even risk-free assets are still on the high side, and that it should likely stay where they are or come down, but not go higher, which will be supportive for the economy and supportive for risk assets in general. So high yield is definitely a lot more expensive than it was. They don't expect a lot more spread tightening, but on the other hand, do not expect spreads to widen meaningfully.
Is that the same thing in investment grade, Michael?
A little trickier because spreads are much more contained in a range. But yes, there's still, I think, an upward or downward pressure on spreads at the margin, but it's kind of like pushing on a spring. The lower you get, the harder you have to press to keep it down. So it becomes vulnerable to negative surprises. So the negative surprise for me would be growth turns out to be stronger and inflation turns out to be not so low. And then suddenly the Fed has to pivot and say, well, maybe we're not going to have 3 rate cuts next year. We'll have 1. So the danger will be we pivot, the economy pivots stronger, and that undermines this very Goldilocks, immaculate disinflation kind of scenario.
Marianne, just very quickly here, are you also bullish on credit at a time when it seems like recession's being taken off the table?
We are, but we do want to stick with quality. We moved our duration and went to benchmark a few months ago. And we've actually been in the high yield market because of the lack of issuance. And one of the themes that we came out with earlier this year is that the 60-40 portfolio is back. But what we're stressing with our financial advisors, the key to the portfolio management of fixed income is going to be laddering over time. Because although we see inflation coming down this year, we think over time inflation is going to reaccelerate and that eventually yields will back up again. And you want to be able to have that steady stream of securities maturing so when rates do back up, you can lock those in.
Michael Kushma, Marianne Bartels, both of you are sticking with us. Let's take a look right now at what is moving ahead of the opening bell. Abigail Zulittle has that. Abby.
We don't have a lot of stocks that are specifically moving relative to that PCE number, but we do have some idiosyncratic movers. Take a look at the shares of Karuna Therapeutics, absolutely soaring at 47%. This is Bristol Myers Squibb, strengthens its neuroscience portfolio with the acquisition of the schizophrenia drug maker for $14 billion. It would add a drug that's close to an FDA decision. Marathon Digital Holdings on pace toward a record 8th up day in a row since going public back in 2012, even as Bitcoin on the day takes a pause. Speaking of taking a pause, Nike down 12%. Of course, their outlook for sales a bit weaker than expected. China's falling short. They're also talking about cutting jobs to save $2 billion. It's interesting, Lisa, because they also have commentary saying that there is a cautious consumer behavior around the world. The stock is now poised to open down on the year. Yesterday, higher on the year.
Abigail, thank you so much. Coming up, Nike, what you were just talking about, delivering a weak sales outlook.
Nike and consumer finickiness shows that consumers are back in control of pricing power. That pandemic wave of pricing power that companies enjoyed is gone. And now they have to offer consumers deals to get them to part with their money.
That conversation is still ahead in markets that are ending the week on a positive note. Not Nike, though. We'll discuss.
As long as consumers have jobs, they will spend. Exactly how much they spend and with how much they lean into the holidays, et cetera, is certainly up in the air still. But they are spending. Nike and consumer finickiness shows that consumers are back in control of pricing power. That pandemic wave of pricing power that companies enjoyed is gone, and now they have to offer consumers deals to get them to part with their money.
Nike under pressure thanks to a weak sales warning. The sportswear giant looking for as much as $2 billion in cost savings, planning to dismiss workers and simplify its product offering. Sales in China also falling short of expectations. The Nike CFO saying, quote, there are indications of more cautious consumer behavior around the world. Nike's competitors are feeling the impact. Adidas and Puma investors fearing a similar sales slowdown. Joining us for more is Bloomberg's Simone Foxman. Simone, what stands out to you and why do you think Nike's warning had such a big impact on its peers?
It's all about this macro negativity, Lisa, because we've watched the impact of Nike's earnings report spill both into suppliers in Asia, then following to rivals like Puma and Adidas in Europe. And now we're looking at weakness among retailers like Dick's Sporting Goods, like Foot Locker in today's pre-market trading. And it really suggests the consumer picture is getting worse from here and not better. And that's especially outside North America. In fact, North America was the only place where revenue actually kind of came in a little ahead of expectations, still down 3.5% year on year. But, you look at China seeing $1.86 billion in revenue versus the $1.97 billion that analysts had anticipated. EMEA also coming in shy of expectations. The message here as well about the consumer weakness. We saw these massive shopping moments, shopping events from Nike. For example, they cited the strongest Black Friday weekend ever on digital and the record number of consumers in their stores. Even Greater China had greater brick and mortar growing double digits during the National Day holiday. But outside of that, the activity just very light, very promotional, according to Nike executives.
Simone, thank you so much. Michael Kushma and Marianne Bartels are still with us. Michael, I want to go to you on this. Does this concern you at all with respect to weakness that could spread?
Well, it's without a doubt that North American growth has been far better than growth outside the United States. There's all sorts of issues. In Europe, the energy price shock was a much bigger negative for Europe than was the United States, and that is still weighing on that economy. It's also true that the ECB has a single mandate of inflation, not growth. So as long as inflation's too high, they're not talking about rate cuts yet because inflation is too high for their taste. So they're not getting expectations of not benefiting from the expectations of rate cuts coming through. And the consumers are more cautious in Europe because of the surge in the energy prices. China, we know the economy has been suffering from the decline in the property market. The reopening post-pandemic wasn't quite as strong as maybe expected, and the consumer's cautious there. Property, I think, is the number one way to accumulate wealth in China, and consumer spending, not surprising then, is on the muted side over there. So growth outside the United States remains troublesome. Monetary policy outside of selected emerging markets is not being, interest rates are not being reduced in those countries. You look in Europe, you look in Australia, New Zealand, the UK, no one's cutting interest rates yet. So this is not buttressing the consumer. So I think the U.S. is still an outlier and has this sort of exceptional economic performance at the moment.
Marianne Bartels, I'm curious from your vantage point if this discourages some of the bull case that you've got with better growth and more disinflation than people expect. Does the international scenario worry you?
No, it actually doesn't, because Taylor Swift's Eras Tour is going international. So if we've learned that what Taylor Swift can do with her economics to an economy is top $10 billion in the United States. Imagine what she's going to bring to these other countries. So I'm not concerned. And if you look at the valuations of the equity markets compared to the United States, they're probably some of the countries, particularly China, are the cheapest that they have been in decades. And I do think you can get some mean reversion, maybe not so quickly from China, but definitely from Europe. And if you look at Japan, Japan is very close, maybe 20% from its all-time record high. And I do think we can go up and test that high. And if you break out and sustain that high, it means Japan is in a whole new secular bull market. And historically, they're very good with technology. And as we're moving to a whole new digital era, with technology, I think Japan looks very interesting, and some select emerging markets. So I'm not as down. And when you look at the consumer here in the United States, if you look at the net worth, their net worth just reached a record all-time high. And when you do a year-to-year change to get the growth, it's growing. Now, the pockets of growth are very selective. The baby boomers really have the chunk of that money and are spending. Low income is struggling a little bit more, particularly because of inflation. If we were to get some type of disinflation in 2024, actually getting some prices down, you're going to actually see consumer spending go up. But I am saying the consumer will spend, but very selectively.
Just real quickly, Michael, just to the final word here, what's your highest conviction trade heading into 2024?
Highest conviction trade is we like that the assets linked to the U.S. housing market, non-agency mortgages, some securitized credit, not so much agency mortgages, but with household wealth, as just this was mentioned, is extremely high right now. And that consumers who own homes are in a really good position, and their creditworthiness still seems to be the most robust of any other sector in the economy.
Michael Kushma, Marianne Bartels, both of you, thank you so much. Happy holidays. Have a good one. Coming up, the morning calls, and later, the merry bells are ringing Invesco's Brian Levitt on why he sees a soft landing for the U.S. economy. This is Bloomberg. Now for our morning calls, a look at some of the analyst recommendations on Wall Street this morning. First up, Needham naming Amazon as a top 2024 pick, raising its price target to $175, citing generative AI productivity advantages. Next up, Wells Fargo raising its price target on Ross stores to $150 and keeping an overweight rating, citing high hopes on softline retail following a material move in the space. And finally, Wedbush raising its price target on Tesla to $350 from $310, seeing the company reaching a $1 trillion market cap in 2024. Coming up, Invesco's Brian Levitt joins on why it is a very holiday mood on Wall Street. This is Bloomberg. Plowing toward an 8th straight week of gains, the longest streak of gains that we've seen going back to 2017. As everyone seems to celebrate around the idea of a soft landing. You can see S&P futures crawling upward toward the open, up 0.2%. NASDAQ up about 0.25%. If you want to take a look at what's going on outside of stocks, it is a bid into treasuries on the great inflation disappearance, the disinflation hope. 10-year yields down about 3 basis points, 385.96. You're seeing dollar weakness across the board with the expectation of rate cuts. The euro 110.30 versus the dollar, the strongest level that it's been going back to July, and crude lifting a bit, but it's been range bound around $74, $75, even with all of the disruption potential in the Middle East. Two stocks to watch at the open: Bristol Myers and a drug developer, Karuna Therapeutics, who agreed to an acquisition deal worth $14 billion. Joining us with that is Abigail Doolittle. Abby.
Hey, Lisa, and we have Karuna Therapeutics absolutely soaring right now, up 48%. Its best day. I'll be able to tell you that in just one moment. Since August 2022, a relatively newer company, I'm guessing, based on that. But it is Bristol Myers Squibb, second sizable acquisition in less than 3 months. In October, they agreed to buy Mirati Therapeutics to expand their lineup of cancer drugs. Today, announcing that they have agreed to buy, as you mentioned, their schizophrenia drug developer Karuna Therapeutics for $14 billion. Now, with this transaction, they gain a promising treatment that is approaching the market, up for FDA approval in September 2024. So far, the late-stage data has shown promise to sharply reduce harsh side effects. The drug is expected to bring in as much as $4 billion by 2030, according to Mizuho Securities. And the purchase highlights, according to those analysts, a buying spree for drug makers paying big premiums to bolster their existing pipelines or enter new areas. Now, Bristol Myers would pay $330 a share in cash for the Boston-based company. That's roughly a 53% premium. Karuna is pretty close to that, but there's still a spread, suggesting some investors think that maybe it doesn't get done.
Abby, thank you so much. Turning to earnings, Nike warning of weaker sales and pressure from a more cautious global consumer. Simone Foxman has more. Simone, what you watching?
Yeah, Lisa, we're watching shares down over 11% in early trading. And remember that this name had been up about close to 30% since its last earnings report. Just today, we've wiped out about half of that gain. We talked about some of the macro drivers earlier. That seems to be what's driving part of the stock, but let's dive a little bit into the financials as well. Earnings per share actually coming in ahead of estimates, $1.03 versus 85 cents anticipated by the street. Revenue just a little bit shy of the overall expectation for the second quarter, $13.4 billion versus the $13.46 billion, but reduced revenue guidance for the fiscal year that ends in May, now looking to be just up 1% for the year, and that's really what's driven a lot of the concerns. Talking about a $2 billion cost savings over the next 3 years, that was what the executives were doing on the call yesterday, including simplifying the sneaker lineup, increasing automation, and of course dismissing workers, something that will contribute to restructuring costs of $400 to $450 million. Most analysts seeing this something like Bloomberg Intelligence does. Near-term challenge, long-term remains a strong, dominant player in the industry. Inventory as well, Bloomberg Intelligence pointed out, is in great shape, and that's contributing to margins. HSBC also put it well as they cut their price target for the stock by $7 to $113. Results reassuring from a margin point of view, but if you want to buy sales growth, look somewhere else.
Simone, thank you so much. Sticking with China, I had some concerns there. Investors caught off guard after the country unveiled new measures reining in spending and content in online games. Katie Greifeld has more. Katie, what you looking at?
Well, Lisa, Chinese gaming regulator on Friday, they did publish those draft rules really aimed at clamping down on practices that would encourage players to spend more time and money in online games. This part of China's fight, of course, against gaming addiction. Now, these draft rules, they include a sweeping set of curves on in-game rewards for frequent logins and purchases. And this is really stoking fears of another industry crackdown. You think about what we saw in 2021 from Beijing, and that really sent shudders through some of these gaming stocks worldwide. If you take a look at China in particular, you had internet giant Tencent plunging by over 12% or so. That is the biggest drop since 2008. And as you can see, peers such as NetEase and Bilibili suffering as well. It's not as much on the angst side if you look stateside. If you take a look at EA, Roblox, and Take-Two, they are seeing much more muted moves right now, really small moves in context, but definitely some of the names that you need to keep an eye on here as this continues.
Katie, thank you so much. Turning to tech, or sticking with tech, Apple stopping online sales of its latest smartwatches days before a U.S. ban will take effect. Ed Ludlow joining us from San Francisco with more. Ed, seemed like the Christmas gift to Apple to force everyone to rush and buy Apple Watches. What's the latest in this front?
Yeah, well, Apple's trading completely flat this Friday before Christmas. Good morning to you, Lisa. The latest is that as of 3 p.m. Eastern time on Thursday, Apple stopped selling the Series 9 and Ultra 2 watch on its website. On December 24th, Christmas Eve, Apple will stop selling those series of watch in its physical stores, around 270 of them in the United States. The news being that the International Trade Commission did find Apple to be in violation of 2 patents relating to blood oxygen monitoring through the Apple Watch. What happens next? Well, a number of options. Apple is working on a software fix. Bloomberg has reported they could go to Massimo, the kind of other end of this patent dispute, and do some kind of licensing agreement, or indeed find a hardware fix. What Bloomberg's also reported is that if you are the owner of one of these generations of watches that's impacted, as of December 24th, you'll no longer be able to exchange it or get it fixed, essentially. The only model or variant that's spared from this is the SE, which doesn't have blood oxygen monitoring. Put into context that even in the most recent fiscal year, wearables and other home goods as a broader category is only 10 to 11% of sales. But it's a bit of a black eye going into the holiday season. Still, Apple up 50% year to date, and the focus of our colleagues on the Tech Watch column is going to be really hard to replicate that performance in 2024, because think of all the other crises this year. The stock up 50%, but increasing domestic pressure in China from domestic handset makers, worries about supply chain, this longer-term shift to India. What a year it's been to cover a company like Apple.
Indeed, Ed, and if you listen to Dan Ives, next year will be even more exciting with the company becoming a $4 trillion market capitalization. Ed, thank you so much. Invesco's Brian Levitt looking ahead to next year, writing, the merry bells are ringing with inflation coming down rapidly and the economy remaining resilient. It appears, at least for now, that the trip down the chimney will be a soft one. Brian joins us now. And Brian, I got to say, that couldn't have been written more perfectly for a day when we got the disinflation data that everyone was looking for, the strong durable goods orders that no one expected, and suddenly we're off to the immaculate disinflation races.
Yeah, it is. It's been a year where things have gotten better relative to expectations, very different than 2022. And to your point, inflation has come down rapidly, and we certainly expected that at the start of the year. But even more so, this economy's been resilient. I think a lot of people expected that we could even be in a recession by now, and the economy continues to be strong, and that's really a testament to the lack of leverage in the economy and the good fundamental strength that we continue to have.
All I can say, Brian, is that you deserve a victory lap for when you came on and you said, you know, I'm a FOMO kind of guy. And we all laughed, and yet a FOMO kind of guy was the way to go this year. Are you still a FOMO kind of guy?
I am, and I appreciate you remembering that. I am still a FOMO guy. I'm hoping I get some good calls for New Year's Eve. We'll see. But yeah, look, it's a market that is really appreciating peak inflation over a year ago, peak interest rates, peak tightening. And historically, that sets up a good backdrop for risk assets. It's hard to find an environment where markets did not do well over the subsequent years after peak inflation. And this seems to be very similar to that. It actually is quite reminiscent of the early 80s when we broke inflation, and many didn't believe it to be true, and yet the markets did very well over the subsequent years.
So the recent rally doesn't worry you? I mean, I feel a little bit like Grinch, because every time people come on and they're really positive and they talk about immaculate disinflation and everything going well and people keeping their jobs and us not having to experience pain, which is a wonderful thing, I think about, well, what if we get reignition of inflation? What about Nike? Is there going to be weakness? Is there anything that's clouding the horizons, or are you just basically looking for ways to get more bullish?
Well, right now, I mean, we're expecting to see at some point in 2024 a slowdown in this economy, not likely the end of the cycle, but a slowdown. But that's what the Fed wanted. So when we hear some economic data that suggests maybe things won't be as good 6-9 months from now, remember, that's what the Fed was trying to make happen. And so what will likely happen is you'll see broader market participation in the beginning of the year, much better than just the Magnificent Seven and very concentrated markets. At some point, the lagged effects of all of this tightening starts to happen, and we slow down. I remind people that equities tend to do well in a slowdown. You tend to want to shift towards higher quality rather than, you know, the riskiest names. But I think the concern is around that slowdown. Do investors start to fear that a recession is forming? It doesn't seem likely, again, given the fundamental strength of the economy. But all years have pullbacks. And if you do get a pullback in the middle of 24 or later in 24, amid slowdown concerns, it likely represents another buying opportunity.
Which is what we've been hearing from everyone. Any dips are buyable. Whether we're going to get a dip because everyone's buying them, we'll have to see. I am curious about this concept of cash on the sidelines. So many people are saying there is so much cash on the sidelines that markets can get a lot more ahead of themselves than we've already seen. And yet then everybody pushes back and says that's kind of a bogus rationale because a lot of this money has gone from savings accounts and checking accounts just simply into money markets and is pretty sticky. What's your view on that?
Yeah, I think you're exactly right on that. I mean, we went from, I think, 18 trillion in bank deposits down to 17 trillion and 4.5 trillion in money markets up to around 6 trillion. So you're right, it came out of one and into the other, and rightfully so, given the higher yield. So I'm not expecting all of that to come flooding into the market. Although, maybe other people start to get some FOMO like I do. I think one of the things investors should consider, those that love 5% in money markets, think about how you can lock some of that in. I mean, we've been saying that for months now, and I think November and December proved that. These yields could come down pretty quickly. So you have reinvestment risk. I'd like to see investors move out into longer maturity treasuries or corporates or munis and, take advantage of those yields for longer than 30 or 60 days. As for the equity market, no, I don't expect it to come flooding in to the equity market, but you do tend to see some momentum in these moves. The market's clearly not euphoric yet, and again, I come back to the simple point that markets tend to do well in the aftermath of peak inflation and policy easing.
You said that it's important for people to lock it in, and we were thinking earlier this year, are you going to be worried more about the reinvestment risk or the preservation of cash risk? Are you saying that still at 3.85% on a 10-year, 3.86%, that it's still a good buy, that you could still see yields going materially lower from here?
No, I don't think materially lower. I think for, investors who were begging for 4% in 2019, and we had to say, look, you have to go out into high yield bonds to get 4%. I mean, today that you can get close to 4% in a treasury or own a core bond strategy or a core plus and augment it some from there. To me, that seems like a better opportunity than sitting around in cash. I'm not saying it's a big total return opportunity, but it's an opportunity to compound 4% yield, especially if we're going back to a 2% inflation world. And, of course, you can look to the municipal bond market if you want to do it tax-free. So, no, it's not a big total return opportunity. That started in the fall. I think a lot of investors missed it, as they often do. But now it's thinking about how you can compound income over time.
In the FOMO world that we seem to be living in, how much is it concentrated and isolated to the United States and not really allowing Europe and the rest of the world to participate?
Well, it feels good right now in the United States, certainly. But if you believe in the soft landing trade, then you should believe in increasing exposure outside of the United States. We're seeing the dollar weaken, which is almost always what happens in the aftermath of Fed tightening. And so you don't need to see the dollar weaken significantly. Just the end of what had been like a 12, 13-year strong dollar environment, just the end of that could have investors looking elsewhere for where opportunities may exist. Valuations, as we all know, are more attractive in the international and emerging market spaces. So if you believe soft landing, if you believe end of tightening, then yeah, international makes sense.
Invesco's Brian Levitt. Brian, thank you so much for everything this year. Have a wonderful holiday.
My pleasure.
Happy New Year.
Thank you.
Let those Berry bells ring as everyone welcomes in a potential disinflationary, immaculate, soft landing type of situation. Coming up, Red Sea trade still in limbo.
The Houthis need to stop these attacks. They need to stop them now. That's clear and simple. And they really need to ask themselves if they've bitten off more than they can chew when it comes to taking on the entire international community.
We've got team coverage on that coming up. This is Bloomberg.
It's very important to understand that the Houthis aren't attacking just one country. They're really attacking the international community. They are attacking the economic well-being and prosperity of nations around the world. So in effect, They've really become bandits along the international highway that is the Red Sea. The Houthis need to stop these attacks. They need to stop them now. That's clear and simple. And they really need to ask themselves if they've bitten off more than they can chew when it comes to taking on the entire international community.
The Pentagon weighing in on the Red Sea disruption following ongoing Houthi militant attacks. Over 20 countries agreeing to participate in the U.S.-led coalition safeguarding commercial traffic, which has slumped considerably as shipping companies scramble to avoid the vital trade circuit. Meanwhile, insurance costs and oil premiums pay the price. Our tween coverage starts now. Kaylee Lyons in Washington, D.C., Javier Blas in Madrid. Javier, I want to start with you. We've been wondering why oil prices have not been responding very much at all to either what we saw with the Hamas-Israel war or what we're seeing with respect to the Red Sea disruptions. What do you make of that?
Well, it's as simple as there is too much supply on the market. U.S. shale is growing to record highs. Production in Brazil is very strong. The growth of the industry in Guyana is also very strong, as is Canada. It's just American oil production from the north all the way to the south is booming, and that is really what is putting a cap on oil prices, despite every attempt of the geopolitics and OPEC to push prices higher.
Do you have any sense, Javier, that that's going to stop, that we're going to see any sort of decline in production, or could it even increase further from here?
I don't think that we are going to see a decline in U.S. production at all. What we may see is a slowdown on the rate of growth as we go in 2024. But in general, the whole oil market, myself personally, we got it wrong in 2023. We thought that American oil production was going to slow on the rate of growth. It didn't. It is growing at a remarkable pace, despite lower prices that we have anticipated. And therefore, I think that making the same bet going into 24, that things are gonna get slow, it's very risky. I think that it will slow, but I'm very open to the idea that I could be very wrong.
This is the reason why I think a lot of people are looking out to next year with a huge question mark around oil prices, Kaylee, given the fact that we haven't seen a disruption in the market side of things. Has that made it a less of an urgent issue for the White House that has been vocal about creating a coalition to combat some of the threat that the Houthi militants present?
Lisa, I would say the White House still very much views this as an urgent threat. I apologize, Javier, but to your point, Lisa, they have really reinforced this maritime coalition, this task force that the Pentagon says now has 20 nations that are involved. The Pentagon describes this as a highway patrol of sorts, Lisa. Effectively, what they're doing is trying to deter and defend, doing things like shooting down incoming drones and missiles from the Houthis, also coming to the aid of ships that need it. But there is an ongoing conversation, according to Bloomberg's reporting, about whether or not this is enough to actually neutralize the threat and allow merchant traffic to continue in the Red Sea once again, or whether offensive measures might be needed, direct strikes potentially on the Houthis. There are a few concerns there about that, though. One being that it could be escalatory, as the Houthis are a proxy for Iran. The other being how Arab allies in the region might react, knowing the Saudi Arabia specifically has been subject to retaliatory attacks from Houthis in the past that have damaged severely their energy infrastructure. And I would note I spoke with Congressman John Garamendi yesterday. He's on the Maritime Transport Subcommittee in the House of Representatives. He used to chair it, in fact, and he noted the Saudis tried for 9 years unsuccessfully to go after Houthis and damage their ability to conduct these kind of operations. He doesn't think the U.S. would necessarily be any more successful.
And meanwhile, we're also talking about the potential for other escalations as well. Kaylee, you are planning to speak with Chief Economic Advisor to the president later this morning. What are the key concerns that you plan to address with her?
Well, especially in light of inflation data that is going the way, Lisa, as we saw this morning, the White House would want. How great of a risk in their mind is there that it starts to reverse once more, given some of what we are seeing play out in the Red Sea, not just in terms of what it could mean for oil and energy prices, but also just supply chains potentially getting snarled, as a lot of these ships now have to go around the coast of Africa and add time to their journey. So we'll get some perspective on that, as well as the fiscal situation here in the U.S. As when Congress returns in just a couple weeks, we're going to be dealing with a real showdown on spending. So there's a lot to talk to her about.
And Javier, before we let you go for the new year, what do you see out of China in terms of demand? This has been a huge question that I just don't have a good answer to.
At the moment, I don't see any particular bad situation in China on demand or more generally worldwide. I know that there is a lot of focus on the market talk about weaker demand going into 2024. It was a recurrent theme also in 2023. I think that the demand is fine. Yes, it's going to slow down in 2024, coming back from a massive recovery in 2023 from the COVID era. But the 1 million, 1.1, 1.2, 1.3 that we are going to get next year is within the typical average for the last 20 years. So demand is fine, supply is the problem.
Javier, Kayleigh, both of you, thank you so much for this and for all your great work this year. And don't miss Kayleigh alongside Guy Johnson in conversation with National Economic Council Director Lael Brainard at 11:30 a.m. Eastern. Coming up, the market-moving events that you need to be watching. That's next in our Trading Diary. This is Bloomberg. Time now for the Trading Diary. What you need to be watching this week. New home sales coming at the top of the hour, plus the U.S. bond market closing early at 2 p.m. Eastern. Monday, a ban on Apple's latest smartwatches will go into effect, and markets are closed for Christmas Day. Thursday, another round of jobless claims. This was Countdown to the Open, with markets rallying for an 8th straight week. This is Bloomberg.